Hey everybody, welcome back. I have a ton to cover, so no fancy open. We're just going to hop right into it. ES Weekly, what are we seeing here? We're seeing a pretty bad day, aren't we? There are three very specific technical things that I am going to go through with you on the indexes that I think are very important. And I think that that's going to help us. We also have to look at where we are fundamentally with the Fed and monetary policy and how that's going to affect us next week, because it's huge. A lot of people are missing the bigger picture with this, so we're going to get into that. But if we just look at the ES and we just look at this drop, it's pretty substantial, isn't it? If we go to the 1 minute chart here and we just go back and do our 830 thingy, as I like to refer to it, where we just mark off that 830 bar and we just see how we reacted to that. It's always fascinating to me how we always get retests of certain areas. Remember, those 830 movements, they're really important. Do we know why they're so important? Because that's where the algorithms and high frequency traders are moving. If you take nothing else from this video, you now know that. You always mark off those 830 bars. That'll be nothing new for people that have been watching these for some time. That's just the way that it is, and that's what you do. Now, if we take a look at this on a daily, there's no way that somebody's going to look at this and be feeling warm and fuzzy about it at all, are they? There's nothing to feel warm and fuzzy about. You now are making your lower highs. You have your lower highs, right? Or I'm sorry, you have your higher lows. So you're getting kind of boxed in here. But what we are seeing since Tuesday is constant selling, constant. And it only got worse with non-farm payrolls. And we're going to get into that and why it actually got worse and why it accelerated to the downside. It's not rocket science. If you were to look at the futures market and say, where could any level of support be? I think you have a level of support right around there, that 53.73. But I think we need to look at very specific indicators to determine what's going on. So we're going to jump into the SPY here, and we're going to have these set up already. And I want to just focus on the key movers. So you'll see up here already that I have the SPY and the NASDAQ. So we have the S&P and the NASDAQ and the SOX and the financials. Why? Because if SOX doesn't go up and the financials go up, we don't have a market. It's just that simple. So they're the four that you always want to look at. If we don't have semis going up, the NASDAQ's not going anywhere. If the financials don't go up, okay, if financials don't go up, then the S&P does not go up very long. Sometimes it'll move with energy, but it's never sustainable. First thing we're going to focus on is rate of change. Now you can see the rate of change here, and it's exactly what it says, rate of change. We can see the divergence that's following us here, and we can see how this is trading up. What I like about this is it's getting definitive, because people will say, well, if we sell down, you can't make money. It's not true. You can actually do quite well when you sell down. It's the lack of a development on what's going on that we have to worry about. And point of fact, just because I think that we're going higher does not mean you're going higher next week. You have to understand that about the market. I do think that over time, this is heading higher, but I think you have some things such as the election and the first rate cut that we have to get through and see how the market responds to it. But for now, you are clearly breaking rate of change. If rate of change is negative, it is impossible for the market to go up. It's just that simple. To have any kind of sustainability, it's just not going to happen. And you're seeing this across the board. So if we go and take a look at the Qs, for example, they look even worse on rate of change. And let's be clear, this all happened in a week. You've been sitting here, but you broke this week. So now I have a lower low on the rate of change. You can all see that right here. And I'm not even there yet on the NASDAQ. Do I need to get there? Not necessarily, but you have to look at this. So if we're looking at the rate of change, and I have a lower low here, and that is definitely something that we want to watch and make sure of and see, okay, well, how's that going to go? We want to make sure that we're watching this on a weekly basis now, and we must look at this, and there's no way to say it, but to have a bearish outlook on what's going on until you are back over that zero line. Now, if you look at the SOX as well, and we go through the SOX, I'm going to do it this way because I have these other linked up here, you'll see in a second. Okay, I'm even worse here. I haven't even broken the low yet. And the rate of change is accelerating to the downside. So I'll say that again. It's accelerating to the downside. It's not turning and bouncing. You have to talk about what's actually going on, not what you want to have happen. So if we were going to look for a support line, we'd be looking right around that what do we have? 184.60 level, right? That would be a level of interest, okay? It's definitely a level of interest for me. And I would suggest that it be one for you. Now, go take a look at XLF on rate of change. What are we doing? We're above, we're positive. Was anything else that we looked at positive? anything remotely positive. Okay, so you have two school of thoughts here. Are these the generals that have to fall first, right? Because they come for the generals last, right? So if everything else is breaking, does that mean financials need to break? You could make that argument when you start looking at JP Morgan and what we saw the other day, right? Or what's going on at Goldman. So I would be watching the Goldmans and the JP Morgans of the world and thinking that if they break, please listen to this, if they break and they wash out, that might be the last move. That might be something that happens into something around September 18th. That would be interesting, wouldn't it, if it worked out that way? So looking at those, you can then go forward, and now we can go take a look at the NASDAQ and where we are in regards to the RSI. I always look at these three, they call them the big three. But look, if you look at the NASDAQ right here and you see what's going on, this is really important for us as well, isn't it? Because you have broken up here, but you're holding on, right? You're not breaking that 50 line. So that's important to me, that we're not breaking the 50. Once you do that, it starts getting worse. You're still not breaking the 50 there. If we take a look at the SOX, you have broken it and you're trying to retest it. And we also remember from the rate of change that what is the SOX doing? It's accelerating to the downside by its rate of change. Please keep that in mind. Look at financials. Okay, so do financials hold us up? Or do financials need to roll like the rest of the market? If you're going to get a clean flush, it has to break like the rest of the market. Let's take a look at the MACD. Now, I like looking at the MACD for one specific reason. When I look at MACD, I really want to look at the histogram and say, is this getting better or worse? Dark red, when you're down, to light red is good because it means it's getting better. Dark red, light red, and then gets darker, yeah, that's not a good time. And so when that happens, that means this thing has to set itself up again. It is very rare to get one dark red bar and not have something else follow. A matter of fact, if you go through this, once it flips, it usually gets another day. And you can see this throughout the years. But go take a look at the XLF, okay? And this provides us with an excellent opportunity to say, financials are holding. Let's look at regionals. Isn't that interesting? But let's get back on point here and let's stick with the SOX and let's stick with the financials, because if we don't have them, we don't have a market. Go take a look at the SPY here. What do we have here with the SPY? Okay, that actually got what? Worse. It didn't get better. Go take a look at the Qs. Okay, did that get worse or better? It got worse. You have to deal with what's actually happening out there. It's actually, from a trading perspective, it's actually not a bad thing. And I just want to get this out there before we go forward. If you are on the wait list, please look for your email. If you're not, get on there. But they're only going to go out next week for like 1 or 2 days. And then, as I stated earlier, I'm raising price because of demand. But make sure that you're on there and please look for that. The link will be in description. I want to give you an example of what you should start looking for in this market. Please watch this. Important parts to get from this, for me, are not really the dollar amounts. What I want people to get from this, let me just highlight this for a second, grab this little, go from there. And I'm not going to have time to edit. All right, 54.2. So 54.02, that's where I'm at. So win rate. Your win rate does not need to be this 80% or anything like that. Now, I want to show a pattern that's actually significantly greater than this. Just understand that this is more than enough to get you to where you're trying to get to. It comes down to money management principles. This account started with like $1.70. It'll reset at the end of the year. That's what I decided to do with it, and drop it back down to like 100. I may actually just do a completely different strategy next year and just do swing trades and just show that. But this is a run and gun account that I do with the community, that's in the community, with the community ideas for being very aggressive. I do trade futures. I don't do it in this particular account. The trading that I want to walk through is something that you can do, futures, options, anywhere, and you can do it in multiple time frames. I don't see it that often, but when I see it, it's a really good one. So let's just get to it. So these are puts. Now, I also did futures on this trade, and I just want to walk through the trade in and of itself. So what I do with this kind of stuff is I saw the entry. And so what you have here is a very specific pattern. Down, up, 1, 2, 3, down. And then you're pulling money out and getting out of the way, because this trade that I'm showing was just options. But I will do multiple trades of the same pattern with different asset classes. So in other words, while this is going on, there may be a short the NASDAQ, something along those lines. It's just how I trade, and I trade through multiple accounts. It works for me. I'll get into a little bit of why I do it in maybe another video, but it works for me. But you can just see here that as it's going down, after it triggers, boom, first move down, boom, next move down, next move down. I'm constantly pulling money out. If you are trading options and you're not doing this, this is why you're running into a problem. I think they actually even will show it down here. Let me see. So here's my point with this. These are the puts. Let's get rid of this little guy. And here's why you want to focus on this, and we're going to watch this live. But I want to show you something. I want to show you someone else that did the exact trade because they're watching me do it live as well. But once you enter, right, in these things, and you can see like, oh, well, you only got, $4 or whatever. I don't care. I'm not there to make the majority of, I'm there to make the majority of the money. But what you need to look at is if I take a look at from where that option was here to how long it took that option to get back to where it was after dropping down, do I really want to go through that? And the answer is no. No, I don't. I don't want to sit there and hope that this thing's going to fall off a cliff again that allows me to get in that trade. What if we bounced all the way back up? Right? Hindsight's a beautiful thing when you're looking at technical analysis. So just keep that in mind. When you're trading options, you want that speed, that veracity that just keeps you coming down. Once you get that, you're in much better shape in getting out of these trades. So I want to walk through this specific pattern, this specific trade. We're going to watch it live, and then I'm going to do a real quick breakdown on it, how you can do it just day by day. If it's of interest, let me know. I do want to do a video on this particular pattern because I've used it a lot and it works. Qs are already breaking. That might make more sense. I'm going to short some NASDAQ here, I think, and then just watch the top of that bar, and I'll close it if that goes over. I don't know that we're going to. That's a pretty bad rejection. I'm going to short some NASDAQ right there, see if I'm going to be able to flip that or not. And if I do, I'll just close it and get out of the way. There it goes. There we go. And we're up on that. Yay, trimmed right into that. I don't care if you're doing futures or at the money puts, but that was simple. Now let's just see what it does. Like right into that, we just want to watch. And right into that, I'm going to trim again. I'll just use the top of that 1 minute bar there. I'll just leave this on now. Nothing for me to do with it. Give me one more bar. There it is. Come on, trimmed more. Don't go over that. If you go over that, I'm probably just going to close a bunch and put the rest at break even. Out. Rest is at break even, probably early. Down to a third. All right, I'm out 100% of that short, 100% out. Let's walk through this briefly so you can actually see exactly what I was doing. And if you heard, man, I don't even know that I mentioned it on that particular clip because I'm trying to save time. But what I was looking for was, it didn't matter to me if someone did it to the futures market, they did it on ETFs. It doesn't matter to me at all, even if they don't do it. Like that's on everybody else to make their own decisions what they do. All I'm trying to do is provide information and education as to what I do and what has worked for me and what has not worked for me over 25 years of doing this. So take it for what it's worth. But I do want to get into this because I do think it's very important for people to get. So here are the Qs, and you can see the 9:30, 9:31, and here is the 4 p.m. bar. So we already know that we had data that day. We all know that we had data that day. I'm not telling you anything that you didn't know. But I do think it's pertinent to just look at these pre-market highs and see that you can't get over there, right? You can see those levels there. But that pre-market high, you were never able to get over. Now, whether you're using the futures market or not, I actually traded futures at the same time, and I just used the Qs. It doesn't really matter. It's 6 1/2. What's important to me is this pattern, and that you understand that I already had my levels drawn. Like it was already done. So prep, number one, be prepared. Number two, you already know where the high of the pre-market is. Number three, you're watching us and you're watching them trying to convince us that they're going to lift us up. We already knew the data was garbage. We just didn't know that if retail knew the data was garbage, and retail's actually getting smarter. But if you take a look here, you'll see it. And it's down, up, 1, 2, 3, down. And this is a very rare pattern, but when it happens, it's really important to note it, but it's down, then 3 up, then down. And that bar usually is undercutting this one. Okay, these are called rising threes or falling threes. This is actually called a falling 3, even though you have 3 that are going up. All right, I know it's weird, but deal with it. So when you see this, you want to take advantage of it. And here, let me show you this. These are the components that make it. It's a big red candle. Big red candle, 3 small green candles, 3 small green candles. Now, I like gravestones at the top of charts just as much as I like dragonflies at the top of charts because they tell me things. But once I broke there, boom, big red candle, yay. Okay, it was on. Actually, it was on this bar, but for different reasons. But once you undercut, that was it. You almost have to try it. But once you see these, they are extremely rare. If anyone that's ever studied candlesticks knows this is extremely rare. This just shows you exactly how it falls down down, up 1, 2, 3, down. You see these patterns everywhere when you start looking for them, but in your time frames. But again, compared to other candlestick patterns, extremely rare. The inverse is also true. Up, down 1, 2, 3, up. Okay, that's extremely rare as well. Rising 3, falling 3. Rising 3, falling 3. Now this is from Bukowski, the Candlestick book. I'll show you that in a second. But falling 3 methods, important results. So he went through something like 4.7 million patterns, something insane. But this does not appear that often, and I'll show you the statistics on it. It's something crazy. But bearish continuation of his theoretical test on this pattern was 71% of the time. Right? So it's better than a coin toss. Whether it's truly 71%, you can go run your own back test. That's what he says. That's what his book says, and he's done extensive work on this. I found this comment very interesting. The falling 3 method candle pattern is one of the favorite candlestick patterns. Reminds me of miniature measured move down chart pattern. And I can see why. That pattern sees price drop recovering during the corrective phase and then the drop resumes. The falling 3 method candle accomplishes all of that in just 5 candles. The falling 3 method candlesticks believe in theories does real life bearish continuation in time reversal. Unfortunately, with 64 samples appearing out of 4.7 candlestick lines studied, performance statistics are as rare as the candle itself. What you have to focus on is different time frames. He's running one time frame on his study. So the more time frames that you're doing it, the more that it will appear. This is the book, okay? And if you go to his website, he has all kinds of data. I have no affiliation with the dude. Just go to thepatternSite.com if you're trying to support him. If not, just go to Amazon and buy the book. I have this book. It's a good book if you're interested in candlesticks. But it doesn't matter if you're seeing it here. It doesn't matter where you're seeing it. Let me give you another way that you can do this. You can go right here, all patterns, click in here, and then you can just click falling 3, rising 3 methods. And to get to this, if you're using this, just type in all candlestick patterns and they have it in here. The problem is they're super technical, and so it might not trigger like it's supposed to unless all the specific technicals are met. But it's another way to do it. Frankly, learning to look for the pattern yourself and see the different variants of it is probably optimal. Smart money, dumb money. Now, we don't really refer to it like that. We refer to it as institutional, and we refer to this as retail. And explaining this is going to get really, really clear on why we do this. So smart is determined by investments that smart would do or institutional would do, which would be large size orders. It would be things along those lines. It would be looking at the size of the futures market and futures trades, things like that. Dumb is going to be ETF flows, things along those lines. So when they say smart and dumb, we're supposed to get excited about institutions because we're supposed to convince ourselves that they're smart, and retail is dumb. I refer to this as what is institutions' money doing and what is retail's money doing. And I find that once you look at it that way, things are a little clearer on which way things are going. Now, the other thing in studying this for years, what I've noticed with it is retail moves fast, institutions move slow. So when you see a change in behavior of either retail or institutions, you really want to pay attention to that, and I cannot stress that enough. And I went through this. I actually went through it for about 15 years, and just going back, I've never really seen it do what it's doing right now, and I'm just going to point it out in a little more detail. But what we do know is that when you get to the top of this level and you start selling down on the retail side, that is usually a clear indication that you are coming to some kind of top. And as I stated earlier, today's going to be really focused on a lot of technicals more than anything else. So when we see this, we're looking for that top, but most importantly, what we're looking for to determine those tops is some kind of spread. And here you have probably arguably one of the biggest, where you're at the top right here to down here, and we can see that spread. Now look at the inverse spread on January, where you can see that we had institutions loaded and retail was panicked, right? We were all panicked back then. And this is pretty fascinating. You can see the spread. But what happened here? We went higher anyway. And we know why we went higher. We had $1.7 trillion out there. People buying in the stock market. People thought there was something called an NFT when really it was just a JPEG. So we understand that there was just let's just call it stupid money that was in here that drove us higher, that convinced people that they knew what they were doing. But what we're always looking for is patterns. And I don't have one that is glaring right now. What I have is I have an issue, and I'm going to point it out. Now, if we start expanding this out to just 3 years, I think it gets pretty interesting. It does to me anyway. So I'm sharing it. You see how you're rolling right here? Right in this area, you keep rolling down. So retail's dropping and institutions are dropping. And it all started last week, probably really towards the end of the week, towards Wednesday, but they don't really go into that level of detail. You can, but we didn't for purposes of time's sake. And I think that's really important to get. Now, there's another thing that I notice here, and whenever I see this, does it come home to roost? Not all the time, but it's worth noting. So you have a higher high in the market right up here, where, well, you're basically in line. And then down here, you have a lower high. It's a concern because if I take a look at institutional buying, which is right here, which is doing the same thing, right? Well, who pushed it up? Okay, so we know that corporate buybacks are at the single largest level that they've been. Okay, so we have corporate buybacks that are out there that are about to go back into a blackout period. We have institution here in blue that is not anywhere near the same level as red is, right? And they're both rolling over. But wait, there's more. Now we break it down to a yearly, and we're going to notice some things that I think, as someone likes to say, are absolutely glaring. And what might they be? Let's try and make this a little bit bigger here. There we go. It's a little bit better for us to see. And what I notice are a couple key things. Number one, if we just take a look at a year. By the way, this is Sediment Trader. I have no affiliation with them. We could argue that we're fine with retail coming in and out and having their little divergences, because you could say, well, we had a divergence all year. And that's fine as long as we're getting that institutional support underneath of us. We're not getting institutional support. What I found that was troubling, what I found that was different than most time periods that I've looked at, and I went through a lot of time periods. I don't really have a time when we're in tandem dropping at the same level. I don't really have anything like that where they're both coming in at the exact same time. I've had it during different periods of time, but I don't have it at the exact same time when they're rolling over. And I went back for years looking for this. So if you go back, look at that 5-year graph, just even in that period of time, if you see a period that I missed, just point it out in the comments. I'd like to see it to analyze it. I usually get these crosses of differentiating of opinions because they both move differently. And that's why I explained that earlier. They both move, and you can see it, where institutions are just taking their time and they're building up their net long position, and retail's just kind of all over the place and always excited about the future, right? Does the cross bother me that happened here? Not particularly, no more than this cross did. Are they places of interest? They are. The disparity between the two is always a place of interest. I guess where my head's going with it when I look at it is if retail is selling, if institutions are de-risking, right, which is a fancy way of saying selling, and we know that we're going to enter a blackout period, and on top of knowing that we enter a blackout period, we also know that going into an election cycle, September and October are pretty weak in general. This paints a different picture, and as I stated earlier, this one's going to be pretty technical. When I look at the market long term, I see a lot of possibility. That doesn't mean that there's going to be bumps in the road. And I think that we're at that point where we're hitting a speed bump here. Now, if you've been watching these videos for some time, we've been doing it, I think, almost 3 years at this point, and you've been in the community, you know that when we come down like this and we start rolling down and finding where that base is going to be, this is year to date, there's a lot of opportunity here, a lot, because they throw everything out the window. What we need to do is just be cognizant of what's going on. So in other words, I do look at some of this stuff and I do have, let's call it pause. For example, if I look at something like this and go, okay, well, that is a trend line. I sure would not like to break that and see that this becomes acceleration to the downside. Nobody's going to want to see that. Nobody's going to want to see this speed up. And that becomes my issue and why I did this on a year-to-date issue as well, where if we look at this, we're exacerbating to the downside. So some of the issues that we're facing, they are macro issues and they're not getting better. And what's happening is, in my opinion, dumb money's actually getting smarter. And I'm going to show you what I mean by that. But I just want to reiterate before we get to that. I don't really have a period in time where dumb money and smart money or institutions and retail are getting out in tandem. I really don't have a period of time for that. So we're going to have to take that for what it is, and we're going to have to watch that very closely. But this is one of the key issues. So we're going to have a little bit of a history lesson on how we got to where we are and why that's so important. And I think it's worth our time. I'm going to just state that. I think this is worth your time to understand why nobody really trusts anything that's going on right now. If we take a look at where we are, they did a great job on this graph, really hammering it home. You can see 83, 88, 94. When did they hike rates? Okay, and then when did they cut rates? I still believe that you're in this sweet spot in here to where we are right now, but we'll see. Time will tell. But this is where you were by 22, okay? And you can see how this is progressing. I just want to point this out that this is not obviously, to scale for a lot of reasons. But if you look at where we were and how fast we hiked in the past to where you are now, we'd never done this in history. And nobody, including Powell, thought that this is where it's going. And I state that so that people understand that nobody has any faith in these guys. They just don't. And there's a lot of reasons for that. We're going to address it. So the Fed has hiked 11 times rates from 0.5 to 5.5%, which has been the fastest and largest rate hike ever in the United States. Meaning for the entire time that we have been a country, I live in the United States if you haven't figured that out, we have never done this, ever. And so people are shocked that this could have effects that people don't understand yet. So that's where we are right now. Now, if we look at this again, just from comparing the speed of these moves, and they did a good job here, the visual capitalist, just breaking it out again on these moves and how we got there. Rates have risen faster than any time in history. And you just compare it again on this chart with how fast we moved. It's absolutely staggering. It's not like it took us even here to get here. So it's not just that they went higher and faster than any time. As a matter of fact, one of the most interesting slides that if you ever go look at the average rate of a mortgage right now that someone has on their home and go look at what a mortgage rate is. In 200 and something years of mortgages existing in the US, it's never had this disparity, and it's creating a huge problem for the housing market. Now, this is how it started, and I think that this is important for us to get. Fed to pump more than $1 trillion in dramatic ramping of market intervention amid coronavirus meltdown. So, and I'm not going to blame them for doing it. We had no idea what was going to happen there. We can all put on our tinfoil hats later. But let's deal with the fact of we didn't know what was happening. This is March 12th, 2020. We can make that a little bit bigger and go from there. So this is what happened to us. And this is how the whole thing triggered. And then from there, it just went on. Now, there are some important parts here of the market to understand. The move pumps in $1.5 trillion. By the time they were done, it was 1.7. In an effort to combat the potential freezes brought on by coronavirus. Remember, everything stopped. And based upon that, they stepped in. Now, once they stepped in, they put their hands into things that they probably shouldn't have put their hands into. But also, you had people at these investment banks that were saying you're not doing enough. So we continue to emphasize the Fed will act aggressively. In particular, central banks are focused on safeguarding market functions at this point. Provide liquidity to scale. However, despite the sharp initial risk rally, we think these measures are not sufficient to durably stabilize the market sentiment in light of credit concerns and escalating health concerns. So while this was going on, you have to, as much as I will blame the Fed for what happened, you have to think about it. At the same time, they're getting advice. And people are only human. You have these people in their ear saying, you're not doing enough. This is not going to even scratch the surface. Now, that obviously turned out to be the case, and they went overboard. This little line really hammers home the issue, and a lot of people don't understand this. Under the new regime, the Fed will extend its purchases across a range of maturities, bills, T-notes, TIPS, Treasury, and other instruments. Now, what they leave out on the other instruments part was that they were out there buying mortgages. Okay, so they are now competing with the person that's going out there trying to buy a home. They're buying mortgages. Them going out there and buying mortgages is going to put the mortgage rate lower than it would have been. Remember, you weren't allowed to go to an open house for about a year in some states. So this completely threw off what the real mortgage rate was going to be because they were out there buying. They were also out there buying bond and equity ETFs. Okay, it's just a fact. So you have 1.7 trillion out there just buying and buying and buying and inflating it, and people thinking that they're smart, buying NFTs of tweets. Now, this is how much money flooded into the market. Now, what transpires from that, let's lower this back a little bit, and I'm not going to have time to edit it nor pop that meme in. Now, what happens here is Fed to start tapering asset buys by 15 billion in November. Taper on track to end 22. Can speed up or slow down. So he starts stating in November 21 that, hey, we're going to have a problem here. We're going to slow it down. We've done all we need to do. But I want to just point this out. From March 2020 to November 2021, they were in the market buying equities and bonds. And no matter how you want to shape, they weren't doing that, they were. And this super inflated every asset class out there. And so you have that deflation that happened, disinflation when they get out of the market. Now, what they say is, it's not going to be a big deal at all. And this is December 15th, 2021. You can put this on pause and go look at the S&P. Fed says we expect 3 interest rate hikes in 2022. So this is what I love. No matter what happens, it's going to make the market go down. They're going to hike rates, market's going to go down. They're going to cut rates, market's going to go down. It doesn't work like that. There's a lot of mechanisms that affect what truly happens when they cut rates. But the important part of this is that there's no trust. So even after they were bamboozled in March of 2020 and didn't acknowledge that they overshot, then you have 2021 December, and he's like, we only think we're going to have to cut rates 3 times this year in 2022. And then if you take a look at what really transpired, after the pandemic, inflation skyrocketed and prices on everything from rent to food increased. Response, Federal Reserve started increasing rates to cool. Pace of rising, hiking its benchmark 11 times between 22 and 23. Okay, so it wasn't 3 times, it was 11. It was the most in history. They have no credibility. And this is really the issue that you're running into. They have zero credibility. They messed up COVID, and you can actually give them a pass on that because we've never seen anything like that. A lot of us were not around for, the Black Plague or the bubonic plague, obviously. So, but what this does do, let's squeeze this down a little, is it just puts it in perspective. They've done nothing since November. And then you go and say, he said 3 rate hikes. Okay, so here's 25 basis points in 22. Here's 50. Here's 75. Here's another 75. Here's another 75. Here's another 75. Here's another 50. Does that sound like 75 basis points? I mean, he was popping them off like Skittles. So it puts us in a position here where he's done something that we've never done in history before, and he exacerbates it with another hatchet instead of a scalpel. And what the ramifications of this, we're all trying to figure out. Now, what's important about this is since December that we've done nothing. It was very clear in July to a lot of people that he should have done something, but they did not. Do I agree with this statement? Wharton said Fed needs to make an emergency rate cut. They should have cut in July. August 5th, Siegel comes out and says cut 75 basis points, and then they might have to cut another 75. 48 hours later, so he must have got a knock on the door because he said, I made a mistake. Did he make a mistake? Or was he on point? I think it was a little over the top, but this shows once again what's going on out there. They are completely behind what's coming. And what they do is they have access to data that we don't. So when they see something, we really don't know how that's going to play out. But if we take a look at what's going on right now in the market as a whole, what we're seeing are a couple key things. This is September that's coming up on the 18th. There's a 70% chance of 25 basis points. There's a 30% chance of 50 basis points. Target rate's 550 to 525. And it'll show you that they're definitely cutting. If they don't cut, we have major problems. But they're going to cut. Okay, there's no way that they're not. And what you're going to see here is from a month ago, just looking down here, we were at 31% chance of a rate cut. Now it's 70 here, and here you are. Now, August 7th, we had a 70% chance of 2 rate cuts, and now it's 30. Here's what's happening. The data's getting worse, and the probability of them doing more now when they probably should is not reflective in what the market thinks. And that becomes a problem. And I think it's a problem because they overshot so many times. They overshot on COVID and what they did. Then they overshot in the course correction. And I think this time what he's going to do is not look like he's going to panic and move 25 basis points. Frankly, I don't think that the guy should be in office. This is my opinion of it at this point because of what he's done. I mean, the amount of stress that's on the housing market for people to get a house and rent is a direct reflection of his monetary policy over the period of the past 3 years. That's why your rent is what it is. That's why your mortgage is what it is. Okay, that's why we have these issues that exist right now. That's why a salad is $47. All right, it all stems back from March 2020 and then the steps that were taken since then. Just keep that in mind when you're trying to understand why this is so important and why the market's going to act to this in a very reactive way until it can figure out what's going on. And I think that's important, specifically with what happened on Friday. We're getting there. What I'm going to do is just skip over November, and we're just going to talk about December. If you look at 550 to 525, which is where you're at, and they're definitely going to cut in December, and there's a 4% chance that, or 8% chance that you're here, and you just look at the numbers and where you were a day ago to a week ago to a month ago, and you realize that, okay, well, something's got to give because the month name levels are right in here, right? They're right around the same. They're inversed a little bit, but they're right around here. But there's only an 8% chance, well, 100 basis points, let's call it, by then. Well, where's the other cut? In other words, if they're only going to cut 25 basis points in September, where's the other 75 coming from? Are you going to go 25, 25, 50? I personally don't think that they're going to be as aggressive as they need to be in September. We will see, and there was a statement, we'll get to that. But this is how they're trying to pitch it right now from Friday's data, which was non-farm payrolls. Unemployment falls suggest orderly U.S. labor market slowdown. This is Reuters, okay? It was not orderly at all. A matter of fact, what they did was they hid it. And this is where it ties into smart money, dumb money, and you can actually see what institutions are doing, and we'll get to that in a second. But this is where it gets really kind of cool. Maybe I'm a nerd for it, but whatever. If you take a look at the non-farm payrolls, people are going to look at the actual number. This is a screenshot from Trading Economics, and you can go to any one of these guys, and it's really important that you do this work. Everybody knows that I preach the macro, the technical, the fundamental, right? Everybody knows that at this point if you've been watching these videos. There are three legs, and they are very, very important to how this all works, right? You have your macro, which tells us, we know who's going to be affected by it, and the technicals tell us when to buy. Okay, if you try to sit at the bar on that, see how my legs went away too fast? Boom, now I've got nothing underneath me, huh? How'd that work out? Pretty good there, actually. If that would have disappeared, that would have been a lot better. It's still sitting there. Don't know why that did. There it goes. All right, cool. So here we are, 142, 160. Looks great, right? And what we saw here was, we're going to be okay because the previous was 89, so they boosted it up. No, what they did was they were supposed to add 8,000 jobs at the government. And so what the government does is goes out there and does a hiring. They hired the exact amount of manufacturing jobs that we lost. So what they do is they hide that the number is actually under that 125, which is supposed to be that break. They actually mask the number by just hiring more people. Okay, it's not sustainable, right? And if you take a look here, non-farm payrolls on the private side, you lost another 20. So we lost manufacturing jobs and we lost another 20 here. And their response to this is to, just get some government jobs and we'll just inflate the number, okay? And I want to be real clear. I'm not just angry about this administration because I guess my voice is going to sound a little angry over it. Every administration does this. Every one, specifically on election year, will play with these numbers and really hide what's going on. And what's going on right now is that the American people are having a really tough time out there. And they're masking it. Now, how does this all tie together with smart money, dumb money? When a statement like this is issued at 11 o'clock that the Fed is going to time to lower rates and we're open the larger cuts at 11 o'clock, and you're wondering why the market's not bouncing or receiving that information, I just gave you 4 years of history as to why. And what's more fascinating is you can actually take a look at how institutions have been positioning themselves a little bit differently. Now, some of you may remember this graph, you might not, but this is the last hour. And I haven't used this in a while because, frankly, I didn't really see any changes that were worth it. And I do now. Specifically, I just want to point them out that this is 5 years. And we should probably take a step back and just understand what this is. So the last hour calculates the last hour of trading and then puts it in a chart. This, in my opinion, is more mid or long term. In other words, it takes a while to build, and then when it builds, and you can see that even like here, you can see how like you curved and then it started lifting, and then while that was still building, eventually it caught on, right? That's what you're looking for here. So when you start seeing divergences in it, it doesn't mean those divergences are coming home to roost right now, but you want to pay attention to that. But you can see, again, how this led to this later on down the line, right? Got it? Good. Okay. And I think it's going to behoove us. There we go. I don't get to use that word too often, but there it is, behoove. I think it's going to behoove us to spend a couple seconds here and just understand, what are you looking at? The last hour is an indicator of cumulative advanced decline line for the last hour of trading of the SPY ETF. So they're taking the SPY and they're taking that last hour, right? The 3 p.m. level. And if the last hour is trading up from 3 to 4, you get a value of 1. right? Yay. All right, now, if an added advanced decline count, now, if it's down, you subtract from the count. So every hour of every day is either what? +1 or -1, depending upon how that plays out. So if 3 to 4 coming in, right, is up, then what are you going to do? +1. If 3 to 4 is down, -1. The more that you have that last hour, the more selling, the more minus. And it just adds it up over time. Okay. Now, the trend model applies a moving average to the advanced decline line, looks for instances when the count deviates above or below the moving average. That's going to signify a change in trend. I like the data. I like knowing what the data is. I'm not going to use I don't need to use it the way that they want it used. I need to understand what it is and then see if I find value in it. I hope that makes sense. I do that with a lot of indicators. See, once you understand what an indicator is, then you can figure out how you want to use it. Now, there are different ways to use different indicators. I truly believe that, but I want the data set and then tell me what the data set is. So for example, if I'm looking at this is how I see it. Well, from when we started to fall off, right, to when we started to turn, you can see that from here, we start going neutral on the last hour. And while we're going neutral, we're dropping. So that in a bowl of soup gets me a bowl of soup, right? But when you start getting to these levels in July and these undercuts, well, now I've got something interesting because I have a market that is declining. And at the same time it's declining, I have an area that's lifting. And what we call that is divergence. And most of my trading, if you've been watching this, builds around not only divergences, but relative performance. I'm very big on relative performance. I want to know what they're buying when they're selling. When they're selling, I want to know what they're buying. I'm always looking for pockets of strength and weakness because that allows me to outperform. But I also want to know what the heck's going on under the hood. In other words, how's the pie actually made? And this gives you a pretty good example of that, okay? And just for a point of reference, we should all know what this date was. That was peak inflation, okay, right there, peak inflation. So, but let's get to this and drill into the time frames. Now, there's a lot in this video, and people watch these 2 or 3 times, so just stay with me. And I know some people like watch certain parts and they don't watch other parts. Some people don't like when I show the trading and they skip through it. Skip through it if this is not appealing and go to the next section. Not really much I can do about that. I would say when I show the trading stuff, they can be used in all time frames. I do plan on getting to a point where we're doing more longer term ideas so people can see that. Really only 25 to 35% of what I do it involves day trading. A lot of people have a misnomer about that. I want to point out this divergence because it's bothering me. And it's not slight, but you should be able to see that right here. I don't know why this is being so aggressive at the tail end of this, but it is. But you see how we're not here? And I know I'm not at the top of that. You see this? It's a little bothersome because they're starting to not buy in the last hour. And this is more of a long-term kind of area that becomes a little bit vexing. So, and when we look at the year here, you can see it a lot more. And we'll just get to it. So you can see it up here, right? See where you're at. And I know I'm not on it, but that's about as good as we're going to get this morning. It's not my fine motor skills that you're watching this for. So see that right there? It's a problem for me. Now, is it the be all end all? No. But do I really have another scenario like that I need to be concerned about? Well, I had one here to some extent, right, on the upside, but we know that was the lower high there. So do we really have a period of time where the market was going higher, right? And then we have a huge divergence like this month over month. And if we look at the last year, you really don't. You have this period in time where you were selling down and then it eventually came home to roost, didn't it? Right? And you see how this happens? This is a really important concept to get about this. So here's March and you just stop and you hit that higher high right here, right? And then you just stop and the market goes higher. And why that's happening, this is dropping. See how it takes a month or two for it to catch up? And then all of a sudden it's miraculously we're down. Well, what happened? Well, institutions stop buying at the end of the day. That's why watching what they do at the end of the day is so important. So where are we here? Do we have any kind of safety net? And from what I can see, candidly, no, I don't see it yet. Now, if we just put this here, come straight across, and you see it here as we just blow it up year to date, you're going to argue that, well, do we get back to that level here? Is there some semblance of support somewhere in here? I don't have an answer to that. I don't know. It seems like this little area in here we've hit a couple times and we've bounced off, haven't we, here and here? Does that happen again? I'm not sure. What I do know is that we need to start watching the last hour of trading. If you're in the community, you already know that I watch the last 10 minutes of trading like a hawk. I want to see what they're doing because institutions are becoming more and more savvy and trying to, mask what they're doing, for lack of a better word. But let's get to some charts so we're prepped. Now, to take the temperature of the market, I'm going to give you 3 names that you need to watch for next week. Number 1 is JP Morgan. You must watch how JP Morgan acts. It is the leading in the XLF. This is what we're dealing with right now. You can see the sell-off. The simplest of indicators, you have broken the 22. You have had 4 days of just nonstop selling, haven't you? You need to hold the 55. So you need to watch this 209 level. You have to watch that. You have to watch how news is going to be perceived. In other words, Apple has news on the 9th. You're holding right in here. If we start breaking this, and we start breaking this lower low right here, so we want to watch the 217.48 level. If we start to break that after September 9th, one, it means the iPhone 16 conversation is just an absolute dud. But that means that we're probably in the market or going lower. So these are the bellwethers, right? Apple, JP Morgan. From a tech standpoint, it's NVIDIA. And you need to watch what's happening here because it is getting worse. It is not getting better. You have a flag right here. It encapsulated it upon itself. I do like that the selling was greater than the buying because it does mean that we're getting to the point of puking. What I'd like to do is I'd like to get a big red bar down. But there are 2 levels here on the video that you must watch. Number 1 is that 97.45. You don't want to break that. You don't. A retest of that level would be just fine if we could get it. But we do not want to break that level. The next level that you would think about, and I'm hoping that we don't get there, but you could, is that $91. At some point they'll step in, but where that is, it always gets more irrational, doesn't it? But I'd watch those 2 levels. That is it.